Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canada's inflation slowed last month as last year's temporary federal tax break continued to push up annual price growth. Data from StatsCan shows the annual rate of inflation ticked down to 2.3% in January compared to December. Gas prices also slowed and shelter price inflation fell below 2% for the first time in nearly 5 years. Prime Minister Mark Carney says Ottawa will invest billions in Canada's defense industry over the next decade via its new Defense Investment Agency. Speaking at an event, Carney said Canada will spend $470 billion on military procurement, as well as defense and security infrastructure. Carney says the new agency will boost exports, grow industry revenues, and raise acquisitions. He says the framework is to build, partner, and buy.
Defending Canada means more than just increasing the size of our military. It also means the strength of our industries, the resilience of our economy, and our capacity to act independently when it matters the most. We will build in Canada and prioritize Canadian companies. As a matter of policy, military procurement in areas where we have sovereign capabilities will be directed to Canadian firms first.
Wheaton Precious Metals is doubling down on its silver exposure with the acquisition of an additional silver stream on BHP's Antamina mine in Peru. Wheaton will pay BHP $4.3 billion upfront in cash, making this the largest streaming deal in history. Once the transaction closes, Wheaton will receive 67.5% of all the silver produced at Antamina. And we'll learn more about the deal when we speak with Randy Smallwood, Chief Executive Officer of Wheaton, at 3 p.m. today. And looking at the markets, a bit of a down day all around. A lot of uncertainty going on right now. And you can see the TSX off by nearly 0.8% south of the border. Not much better down there when we look at that. Yeah. S&P 500 off by about 0.2, a little under that. Dow Jones down by 0.13, and the Nasdaq off by 0.28. Canada's headline inflation rate slowed slightly to 2.3% last month compared to economists' expectations. They were calling for it to hold steady at 2.4 as last year's temporary federal sales tax break continued to push up annual price growth. Let's get more now from Jimmy Jean, Chief Economist and Strategist at Desjardins. Jimmy, thanks as always for joining us.
Thanks for having me.
Okay, overall, how do the numbers look from a broad perspective?
Well, if you're a central bank contending with above target inflation, I think you're satisfied with what you're seeing today. Not so much the surprise to the downside, but also when we look at the core indicators, the core measures, and we tend to look at them on a 3-month annualized basis to get the direction of travel. And what we're seeing is that those measures are pretty low right now, coming in at 1.2%. That's the slowest pace since 2020. So that does suggest that when you look outside the distortions, really you're seeing growth weakness, but that growth weakness is starting to bring down inflation overall. So the next few quarters look promising on that front, and the Bank of Canada, as a result, could change its tune.
And is it good things that are driving the prices down, or should we be concerned about it?
Well, we're seeing some relief in things that many consumers care about. So, for example, rent decelerated. We actually had a decline, a month-over-month decline in rent, and it's the first time we see that since last January, but it's the most significant monthly decline since 2020. So that's very encouraging. And it's in line with what the StatScan's measures of asking rent have been telling us for some time. We know that population growth is slowing very, very fast. Temporary residents are declining, and so demand for housing is falling, and that's having an impact on rent. And then the other thing is food, for which we see a bit of a deceleration. It's still elevated for sure. But we see it going in the right direction. For this particular release, gasoline continues to weigh to the downside. So it's not to say that there's not still some distance to go to really talk about relief and lasting relief, but that release really goes in that kind of direction. If we were to see some follow-up weakness in inflation, I think the Bank of Canada would have a harder time justifying staying on hold.
Okay. And we're going to talk about that in a second. I just want to still look at some of these things. The consumer carbon price, we saw that end. What kind of an impact are we seeing with that? What role is that playing?
Well, yeah, this is still part of the picture. And, we're going to have this downward effect on inflation disappearing next spring. So this acts to the downside. But on the other side, you had the GST break of last year, and now we're comparing a period where you don't have that GST break. So it's pushing inflation higher. So net it kind of cancels out. It's overall policy distortions, but we have indicators that look through that, and they're telling us that inflation really, on a near-term basis, is decelerating quite quickly.
And were there any sectors the end of the GST break was a bigger factor?
It's mostly in restaurants in particular. That's where you see it's affecting 10% of the CPI basket overall, but you see that affecting categories like restaurants, categories that had been targeted last year as subject to those tax breaks. A number of food categories lasted a couple months. So in the next report, we should see that effect disappear. And so that should already bring the headline numbers closer to what our core numbers are telling us. And then the other part to get rid of will be the carbon tax effect, the carbon tax distortion. That will be the next spring. And then we'll get some purer measures of inflation. But the underlying trend is still weak growth, weak consumer spending, like I said, falling population. On the part of the temporary residents, and that's all those stories are disinflationary.
All right, and with all that, then you mentioned about the Bank of Canada rate. Where do you see it? Do you see them standing pat then for most of the year?
We're still in that camp officially, so we have the Bank of Canada on hold until the middle of next year. However, this is always contingent on the data. Roughly speaking, matching what their expectations have been. And it does seem now that growth is weaker, surely than what they anticipated last fall. And so we don't see any growth at all for the fourth quarter. It's still early for the first quarter in terms of the data we have on hand, but we certainly don't expect anything above potential at this point. You have question marks in the housing market, given weaker demand, and also all the uncertainty related to trade policy ahead of those CUSMA revision talks that are also likely to keep businesses on the sidelines. So it seems that we do have a combo that is quite negative for growth. Not saying that growth should contract, but we should have at the very least very, very weak growth, and the chance that this growth underwhelms even the Bank of Canada's measures is still significant. And if that were to be officialized in the next numbers, that we think the Bank of Canada might set up things for maybe a cut here.
And how much of a factor looking ahead over the next year is the CUSMA negotiations in affecting all of that?
Well, that's the major wild card here. Although we don't expect the U.S., for example, to pull out of NAFTA of CUSMA, excuse me, we think this would have too much of a damaging impact on the U.S. economy and U.S. inflation per se. But we could have something where, for example, the U.S. maintains those sectoral tariffs. We don't have an agreement to extend the agreement to until 2042, and in this case, we would have annual revisions, which would keep businesses in limbo, and that would hurt investment and hiring. So that could be a negative scenario. That's not what we assume as a base case, but something we're following. Certainly, the bright scenario would be to have all those tariffs removed, but that's very unlikely as well, given Trump's insistence on tariffs as part of his policy.
Okay, Jimmy, we have to wrap it up there, but thank you as always for joining us.
Thank you.
Jimmy Jean is chief economist and strategist at Desjardins. Up next, are development charges quietly driving Canada's housing crisis? We'll break that down when we come back. A new report from the C.D. Howe Institute warns that Canada's housing supply relies too heavily on upfront development charges, a system that drives up costs for buyers and renters and discourages new construction. For more, we're joined now by Colin Busby, Director of Policy Engagement at the C.D. Howe Institute. Colin, thanks very much for joining us.
Thank you for having me.
According to your report, what kind of an impact is that having, the development charges, the upfront development charges?
So municipalities rely very heavily on development charges in the building of new homes. And, it ranges a lot across the country, but in Canada's large, sort of more populous urban centers, it's not entirely irregular for housing development charges to add upwards of $50,000, $100,000, or potentially even $200,000 to the overall cost of building a new home. And so it's a substantial amount. Municipalities rely on it because they would like to fund housing-related infrastructure and the cost of housing-related infrastructure over the use of adding a new house to, for example, water and wastewater facilities. And so they charge it over the entire lifetime, all upfront, one upfront charge, and it creates a lot of challenges. Obviously, it sort of raises the cost of building new homes. And it also raises the cost of the existing housing supply because they don't have to compete as substantially with new homes. So municipalities are sort of stuck in this habit of wanting to finance housing through a one upfront lump sum charge. And so it's, increasing the sticker shock of building new houses. It's making housing less affordable. And we need to try to find ways to break that cycle and to find ways of financing new housing-related infrastructure in a way that's going to promote housing affordability, as well as ensure that municipalities have the revenues they need to finance housing.
Now, is it not simply a case of, it's either pay now or pay later when it comes to that? They have to do that work that they have to do. They need the money. What other options do they have?
So municipalities really have a choice to make, and sort of they need to be working with the provinces on some of these issues as well. But what they could do is they could set up functioning independent arm's length utilities that would charge ratepayers for the costs of housing related infrastructure over the life cycle, as opposed to in one sort of upfront lump sum charge. So for instance, the way this could potentially work would be to have a water, wastewater utility associated with a large Canadian municipality, and they would be allowed to issue debt. For instance, they'd be allowed to issue debt and allow them to raise rates on ratepayers to pay for the costs of building that infrastructure, of maintaining that infrastructure over its natural life cycle. But this is not an easy thing. Municipalities are certainly in the habit of relying on development charges, upfront development charges. It's nice to have sort of all that money in the bank. You can understand why it's an attractive feature for municipalities. But moving away from it, how do we enable municipalities or their utilities to issue more debt? That's a real challenge. It challenges the way provinces have done things. It challenges the way municipalities have done things. But we have to seek this out, and we have to try to find these options more attractive, because finding other ways to lower development charges just doesn't seem to be gaining a lot of traction.
Now, are there areas that are doing this where they are allowed to run debt, build debt, and is there not a danger that they could end up like some provinces and the government where we're running deficits every year? How do you protect against that? I mean, municipalities are one of the only places they can't run a debt, can they?
Yeah, I mean, so one example that comes to mind in terms of an area where there are opportunities for some municipalities or municipally associated utilities to issue debt would be things like electricity and electrical system operators. So it's not like it's without precedent, but it's a challenge because the way that provinces tend to oversee the finances of municipalities is they tend to have very, very strict rules in terms of how they can issue debt, why, and under what sort of criteria. And so I just think it's inevitable that we have to try to work at producing options that's going to allow municipalities to issue more debt, whether that's debt that is potentially non-taxable debt. That could be an attractive feature for municipalities. How could we encourage utilities and the development of utilities that are they themselves, issue debt that aren't, and that there's good rules and responsibilities on them to ensure that those that they follow through on those debt, they pay off their debt, and that those don't essentially get passed off to higher levels of government. But it just seems like this is an inevitable frontier that we're going to have to push through if we want to make new housing affordable in Canada and a lot of cities in Canada, and at the same time start to reduce some of the prices on the existing resale stock as well.
Now, could you see the provinces and the Fed open to this? It's a complete overhaul. I mean, you also want them to change how they their rules, and when it comes to the missing middle housing, duplexes, triplexes, federal flexible ownership models. Could you see the government willing to overhaul the system that much?
Yeah, certainly it's a challenge for higher levels of government to try to encourage municipalities in moving in this direction. So federal government incentives to try to get municipalities to reduce their development charges really, are not having the appeal perhaps that the federal government would like. So I think the things that potentially higher levels of government could do would be to make a lot of municipal debt issuances non-taxable, try to find other alternatives to allow for the establishment of forms of governance of municipal level utilities that can issue debt in ways that are applicable, well regulated, not a source of public concern. But the toolkit is not large. I know a lot of people would want to see the federal government and the provinces start to introduce more conditional transfers to municipalities, but it's not clear to me that is necessarily going to be the solution. I think we need to find ways of potentially even using higher level government expertise in establishing large form utilities, debt issuing agencies, and perhaps lending that expertise to the municipal level and showing them how it can be done might be part of the toolkit that we can use to start to improve housing affordability in Canada.
Okay. Thank you very much, Colin, for joining us. We're out of time, but appreciate you joining us.
Thanks for having me. Colin
Busby is Director of Policy Engagement at the C.D. Howe Institute. Up next, we'll get more coverage as we digest the latest inflation data in the context of food prices. That's after the break. Food inflation accelerated to 7.3% annually in January. Now, that surge mostly tied to the federal government's tax holiday that was brought into effect a year earlier. It's now over. Let's get more on this from Dana McCauley, CEO of the Canadian Food Innovation Network. And Dana, thanks as always for joining us.
Oh, it's good to be here, Roger.
Not so much the numbers, though, that we're looking at. 7.3%. I know that's tied in with the tax break we had at the time, but still a concerning number, though.
It is. It is. I know. Even if you take out that echo effect, of having the GST holiday last year, that so many Canadians took advantage of to eat out more often and to kind of splurge on some of those fun foods. We still see that food is one of the most vulnerable parts of the economy, and that the recent shocks to trade, et cetera, have an outsized effect on our grocery bills.
And I know we saw there was a bit of a break, I think, on fruit. We saw some prices there dropping. Where do we see some increases, though? What was hardest hit?
Well, of course, things that are in cans, anything that has to do, with tariffs, we're seeing issues there, and foods that have been impacted by supply chain issues to do with weather. Of course, that's interesting as well. And I'm one of the Canadians who has, committed to buying as much Canadian food as possible at the grocery store, and then anything other than U.S. food if I can't satisfy my needs that way. But of course, when I'm buying, pomegranate from Greece versus a pomegranate from the U.S., there's a whole lot of supply chain and a lot of demand on those products that, is putting upward pressure on the prices. So the imported foods are definitely a big part of this.
And does it feel like it's calming down a little, or are the numbers showing that it might be calming down a little, or is there more to come?
It does seem to be, easing a bit. Generally, inflation is down, and I think the GST holiday that the Prime Minister, or the GST rebate, sorry, the holiday was another Prime Minister ago, but this GST, rebate that people are going to get is a nice Band-Aid that, if consumers choose to use it to, buy groceries, will be helpful. But we really do have some systemic issues, and the government did acknowledge that, their investment in the Strategic Response Fund and the, depreciation incentives that they put on greenhouses, that shows that they are thinking about how to fix the agri-food supply chain to make it more shock resistant and to help Canadians to at least expect prices to stabilize, if not to go down.
And what would you like to see them do there?
Well, I think, the big issues that we see are that, Canadian companies who are producing and manufacturing food, they need to be modernized. They're using, in some cases, really outdated technologies that don't allow them to have different ends of the supply chain speak to one another. So they have losses in inventory, and they miss, all kinds of opportunities to reduce their labor costs and to avoid waste. So we really, really need to incentivize companies to adopt technologies that will make them more productive and more competitive, and that help to connect the various types of steps along the supply chain so that they're just more seamless and, more integrated.
And are we starting to see companies do that, or do many feel they kind of have to sit right now on the sidelines almost and wait and see how everything resolves itself when it comes to the tariffs and CUSMA next?
I think there's a chill over a lot of spending. A lot of people are trying to figure out, what is my market and who do I sell to and what price points do I need to hit. FCC's announcement last week that they will be taking together a consortia of investors and putting $5 billion into agriculture and food companies before 2030. I was in Ottawa last week at a lot of the Ag Day Canada events, and there were a lot of people going, oh, okay, and that's loosening them up a little bit. But we really, we really need to get some continuity, and people need to feel, and by people I mean the business owners, those food innovators who are running companies, that are creating food and the solutions that those companies need. Those folks really need, an injection of cash and some confidence that what they do today will still matter tomorrow. It's been radical optionality every day for, since the pandemic, basically. And there's a lot of people who are waiting.
And just looking one last thing I want to look at here, the restaurant meals 12.3% jump year over year, again because of the breaks there. But the restaurant industry is struggling, and that can't help it. Knowing the prices have gone up that much, it's more than just food there, isn't it?
It is. There's the labor cost, of course, and rent and fuel and lights and all the things. Every input for a restaurateur has gone up, and they are struggling. Some of them are negative margins. There's one prediction that we'll lose 4,000 food service outlets in Canada in 2026. And interestingly enough, as we market ourselves as a tourist destination, a lot of that's predicated on the food culture that we offer. And if we don't have a healthy food service sector, that's kind of a promise we can't deliver on. So we really need to figure out how to very quickly help the food service sector to, level up their use of technology and get their pricing in order so that we can have those places to go to, because they really do create the vibe in Canadian cities, and we depend on them not just for food, but for a lot of our culture.
Okay, we'll have to wrap it up there. Dana, thank you very much for joining us, though.
It's a pleasure. Thanks so much.
Dana McCauley is the CEO of the Canadian Food Innovation Network. Coming up, Ottawa is pledging billions for Canada's defense industry over the next decade. We'll break down the details after this. Canada's inflation rate slowed last month. Data from StatsCan showing the rate ticked down to 2.3% in January compared to December. Economists were expecting CPI to remain steady at 2.4%. Gas prices seeing a slowdown, while shelter prices fell below 2% for the first time in nearly 5 years. Some analysts believe that even though the report shows signs of inflationary pressures easing, it is unlikely to sway the Bank of Canada. Canada has signed a preliminary trade agreement with Mexico. Minister of U.S. Trade Dominic LeBlanc says Canada and Mexico will work to expand port-to-port trade and will also hold talks on security. Ottawa also sees investment opportunities in the pharmaceutical and agriculture sectors. The delegation is in Mexico until Friday. The pace of home building across the country continues to see a slowdown. Canada's Mortgage and Housing Corporation says the annual pace of housing starts declined 15% in January with no near-term signs of a turnaround. The agency says it expects new construction to continue trending lower, affected by trade and geopolitical uncertainty, high construction costs, weaker demand, and rising inventories. And a quick peek at the markets. The TSX, after that big bounce back on Friday, closed for the holiday yesterday. It is off today by more than 0.5 point. And south of the border, U.S. markets, it's been a yo-yo day for them. At one point, they were down fairly noticeably. Now they're up a bit of a wash for the Dow, but the S&P 500 up a little more than that, 0.11, and the NASDAQ up by 0.15. Well, Prime Minister Mark Carney has announced a $6.6 billion defense strategy aimed at strengthening security, creating prosperity, and reinforcing strategic autonomy. CTV's Rachel Aiello joins us now to break down the details. Rachel, thanks as always for joining us. What are some of the details? How is this going to shape up? How do companies look to benefit?
Yeah, absolutely. Thanks for having me. So this is specifically Canada's defense industrial strategy. So this is a piece of the overall increase in defense spending focused on how to build up the Canadian sector. Essentially, the goal of this, according to the federal government, is to build up how much the Canadian Armed Forces can be equipped by made in Canadian goods. So underpinning this whole strategy is this framework that the government is calling Build, Partner, Buy. So essentially that means priority number one one will be building as much as they can in Canada. When they can't do that, their next step would be to look to allied countries to try to partner in the development of whatever defense goods it may be. And then last case, worst option essentially would be having to buy off the shelf. But in that instance, the government is asserting there would be conditions to ensure that the Canadian industry, Canadian workers can still in some capacity benefit from that procurement. And as part of the strategy, there's some big numbers here. We'll walk you through kind of the top line commitments. So over the next 10 years, they are estimating this could get 125,000 new jobs in Canada. They want to boost Canadian defense exports, so what is made in Canada that we send abroad, by 50%, and also want to increase the number of Canadian companies getting defense contracts by 70%, or get it up to 70%. So those are some of the big ambitions here. Broadly, the aim, though, is to increase our own dependence and not have to rely on foreign suppliers to protect ourselves, essentially.
All right. And I guess the timing of this, why now?
Yeah, so this is really the latest example of how the federal government, specifically Prime Minister Mark Carney, is trying to reshape the Canadian economy with the concerns about Canadian sovereignty, the Made in Canada approach, now the Defence Edition. So the Prime Minister was saying today, essentially, is, in his view, Canada, for many decades, has not spent enough on the military, has not invested enough in building up our own economies. We have been too comfortable, too reliant on our geography and our partnerships to keep us safe. And he's made it clear, without saying the United States, that that dynamic has shifted, and Canada needs to now be a strategic partner to other countries like in Europe, as an example, but also needing to no longer be a dependent. So the Prime Minister is really making the case that this is necessary now to build up Canada's sovereignty and to assure that there is more that can be built at home. And I do get the sense that part of that is a desire to help out some of the industries that have been so hardest hit by Donald Trump's tariffs. I'm thinking steel and aluminum, trying to find ways to build up the defense force, but also building up Canadian sectors that are being squeezed right now, Roger.
Okay, Rachel, thank you for that update.
Thanks.
That was CTV's Rachel Aiello. Coming up, Ontario is lifting the cap on post-secondary tuition. We'll look at what parents can do to manage that road ahead after the break. Well, the government of Ontario is lifting the cap on post-secondary tuition as part of a major funding overhaul, a move that could raise costs for students. We are looking at how registered education savings plans can help parents prepare for this with our next guest, Tina Taranchian, Senior Wealth Advisor at CI Asante Wealth Management Limited. Tina, thanks as always for joining us.
Thank you, Roger, for inviting me.
So they're lifting the cap. How much are they lifting the cap? And this is just an added stress for students and their parents, isn't it?
Yes, it definitely is an added stress because the cost of education, higher education, have been going up higher than inflation over the last few decades. And this will add to the stress, definitely, for parents, which makes it more imperative that they use RESPs as a tool to help them save for their children's education.
Now, have RESPs gone up, or do they go up on a regular basis, the cap or the window for them?
No, it has not changed. The maximum that could be contributed to an RESP for a child is $50,000. The government pays matching grants called Canada Education Savings Grants on maximum $2,500 per year, 20% matching, so $500 grant per year, and you can carry forward only 1 year if you have not used the grant in the previous year. So you could put up to $5,000 per child and get a maximum of $1,000 grant if you have room from previous years.
Okay, so, and I guess the question, it's best then to start pretty much as soon as they're born then.
Yes, that would be the best scenario. The maximum grant that each child is entitled to over the lifetime is $7,200. So it would be best to start as soon as the children are born. And if you delay it, then make sure that you do take advantage of carry forwards.
And what's the best way to invest it? You have your choices on what you can do. You can do it with your own advisor. What do you recommend? Do you have a balance, a mixed balance? You put it all in mid, higher risk?
It really depends on the age of the child when you start the RESP. Obviously, if you start it as soon as your child is born, you have a good 17, 18 years until they start using the money. So that's a relatively long time span. And if you have the tolerance for risk, you could even invest it all in equities. If you start later, then your time horizon is going to be shorter. And again, depending on your risk tolerance, you may want to be in a balanced portfolio. The closer you get to the time that the kids need to withdraw money from the RESP, the more conservative you want to make the mix.
Now, what are some of the pitfalls and dangers you should be aware of as you're building this and as you're saving it?
Well, some of the least known things about RESPs is that people think that they can only be used for college or university education. But the good thing is that you can actually use RESPs for qualified trade programs and technical schools. So your child does not necessarily have to go to a college or university. The principal amount that you contribute to an RESP, you can take it all out tax-free because it's after-tax money that went into the RESP. What you have to be careful about are the grants and the growth on your money. So the grants can only be used if your child goes to a qualified higher educational institution. You have 35 years to use those grants. Mm-hmm. So there's a long window of time. Your child, even if they want to take time off or wait until they start their higher education, you're not going to lose the grants. And if they have siblings and your child ends up not going to any qualified post-secondary educational program, those grants and growth could be transferred to a sibling and they could be used. The worst case scenario is if your child does not go to any higher educational institution, you will have to pay the grants back to the government. You will have a choice of the post-secondary education that the grants will go to. You do have that choice when you set up the program. And any growth on the money, the accumulated income payments that have grown over the years, you have two choices. You can either withdraw it if the plan has been around for at least 10 years. You could withdraw the money. You will have to pay regular income tax plus a 20% penalty tax on it. If you have room in your RRSP account, you could transfer up to $50,000 of the accumulated income payments or the growth in your RESP funds to your RRSP and let it grow tax sheltered there and avoid paying that 20% penalty tax.
Okay, so some things you have to be. And can you use that money for expenses beyond tuition?
Yes, definitely. The only restriction is the first 13 weeks of school, you can only withdraw a maximum of $8,000 for post-secondary education. And if you're in a part-time program, you can withdraw only $4,000. After the first 13 weeks, there's no limit on the amount that you can withdraw, and you can use it for tuition, for room and board, for any purposes.
Okay, we'll have to wrap it up there, but actually, one last quick question. Is the deadline for contributing the end of February, like your RRSPs?
No, actually, it's December 31st.
Okay.
So you have until the end of the year.
Perfect. Tina, thank you as always for joining us. Appreciate it.
My pleasure, Roger. Thank you.
Tina Tarajian is a Senior Wealth Advisor at CI Asante Wealth Management Limited. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. let's take a quick look at the markets before we head south, talk a little bit of what's going on there. But for now, TSX, you can see, is off for the day. Closed yesterday, had that big rally on Friday, but down today. It's cutting the loss. It was down quite a bit earlier, but has gained a little bit. Quick look at some of the gainers right now. Bombardier is having an up day, as is TerraVest and MDA Limited. You can see they're all in around the 5% gain range. Bombardier, one of the reasons for that, probably just announcing that it is buying. Brown, Gibbons, Lang and Company's Velocity Maintenance Solutions, a Chicago-based company, they're buying that, the Velocity Maintenance Solutions. Okay, let's head south of the border for some movers there, and we're joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us.
Thanks for having me, Roger.
Okay, I'm really excited. I was reading the program about this episode of Warner Brothers, and I think this is where they find the killer, isn't it?
Yes, well, I actually would not say that the mystery is solved yet of who's going to close the deal with Warner Brothers, but we're certainly getting continued plot twists here worthy of a TV drama. The latest twist in this story is that Warner Brothers has agreed to reopen negotiations with Paramount Skydance, one of its suitors, and Netflix, which already agreed to buy assets from Warner Brothers Discovery, has granted the board a 7-day waiver for those negotiations. Now, if you think back on the state of play here, in November, Netflix agreed to buy Warner Brothers Studios and the HBO Max streaming service for $27.75 a share US. Paramount launched a hostile bid for the whole company for $30 a share. The idea here, Paramount is supposed to up its bid to at least $31 a share. Warner Brothers still waiting to get that in writing, still recommending that shareholders support the Netflix offer, but the stock is up about 3.5% today, so shareholders are betting that there's at least a chance that they're going to be the winners with a higher offer in the end here, and probably everyone's going to end up turning their attention to this March 20th date for a shareholder vote on the Netflix deal.
All right, and then is it done at that point, or can we have a counter to the counter to the counter, which was a counter to the counter?
I mean, my understanding is things will be pretty set once there's shareholder approval of the deal. I am not an M&A expert, but I do think that is the date that really looms large right now in people's minds. Of course, we could get something out of these negotiations in theory, though, that changes the state of play there and changes the offer that the board wants people to vote on.
All right. Gemini Space Station, is anyone up there flying? I know it's not in space, but they're losing. The help wanted sign is hanging out there, isn't it?
Yes, I would say more crashing down to Earth right now. Gemini Space Station down about 14%, heading for the latest in a series of record lows. This is actually not a space company. It is a crypto exchange and one of many crypto-related stocks that has been suffering lately. This on some company-specific issues. They said today their CFO, COO, and CLO, Chief Legal Officer, are stepping down effective immediately. Also reported some worse than expected preliminary results for last year. And this comes after they announced some job cuts, scaling down operations in certain regions. We were talking about that just a couple weeks ago. So that's really hit shares of this company. Went public last year, down around 75% from the IPO price. And of course, if you look at the broader crypto environment, the slide in Bitcoin, you can't imagine that helps here.
No, there's a lot of people I think might be hitting the panic button a little bit in that sector. Okay, Wendy's, things not so hot there.
No, and you want to talk about plot twists. We've got some whiplash for investors in Wendy's here on actually the second day after they reported earnings. So some volatile trading on Friday, ended the day in the green, but now down as much as 10%. That's the worst day since 2022. Wendy's made some comments that investors took positively on Friday. They said they expected the fourth quarter to be the bottom of sort of a downturn for their business, but analysts are throwing some cold water on that today. You look at what Morgan Stanley says. They say that if things are going to play out the way Wendy's expects, you need to see a real inflection in the business this year. You need to see a continued recovery after that. They think that's possible, but they say they are in wait and see mode about it right now, maintaining an underweight recommendation on the stock.
Got to wrap it up there, Matthew. Thank you, as always, for joining us. Bloomberg's Matthew Griffin. And that is this edition of Trading Day. Have yourself a great afternoon.